Welcome back to Market Meridian Finance. I'm Eric. Today we are focusing on one of the most talked about assets right now, gold. Over the past few trading sessions, the precious metal has shown incredible resilience, and right now, the market is rapidly pushing toward the key previous high at $5,340 per ounce. That level has become the major focal point for bulls, and today we're going to break down exactly what's driving this move, what to expect for Friday's trading, and what the best and worst case scenarios could look like for gold investors. First, let's talk about the core story here. Even if we see a short-term pullback in gold prices as geopolitical risks around the world begin to ease, investors need to understand one critical point: the downside for gold is likely limited. This is not a market that is poised for a sharp, sustained drop, and the reasons are very clear. We have three major fundamental pillars standing firmly under gold prices right now. Number 1, growing expectations for Federal Reserve interest rate cuts. As the market continues to price in looser monetary policy from the Fed, non-yielding assets like gold become far more attractive to institutional and retail investors alike. Number 2, falling U.S. Treasury yields. When bond yields move lower, the opportunity cost of holding gold decreases, which directly supports higher gold prices. And number 3, a structurally weaker US dollar in the medium term. Since gold is priced in dollars globally, a weaker dollar almost always translates to stronger bullion values. These three factors combined create a powerful floor for gold, and that's why even during pullbacks, buyers continue to step in. As senior strategist Grant recently stated, and I quote, "A short-term correction does not change the medium-term bullish structure for gold." The targets of $5,340 and even $5,400 per ounce are still very much within reach. That's a strong vote of confidence from someone who watches this market closely every single day. Now, turning to the immediate sentiment across global markets. Ahead of the highly anticipated Vienna talks set to conclude next week, caution and neutral positioning have become the dominant mindset. Most traders are unwilling to place large, aggressive bets ahead of a major event that could shift geopolitical dynamics overnight. That's completely normal in a market facing event risk. But here's where long-term investors can separate themselves from short-term traders. Every dip in gold that is caused by easing geopolitical tensions, those are not signs of weakness. For investors with a longer-term view, those pullbacks are actually excellent buying opportunities. Let's think about the bigger picture. We are approaching a potential Federal Reserve rate cutting cycle. We are seeing a dramatic reshaping of the global geopolitical landscape. And we are navigating rising economic uncertainty brought on by the rapid expansion of the artificial intelligence wave, which is disrupting industries and growth models across the globe. In this kind of environment, gold's traditional role as a safe haven asset and a store of value becomes more important, not less. That is not going to change next week, next month, or even next quarter. Now, let's get to what you're all here for: Friday's market outlook, including the best-case scenario and the worst-case scenario for gold prices. Starting with the best-case scenario for Friday. In this situation, gold receives fresh safe haven buying, supported by continued softness in the US dollar and Treasury yields. Geopolitical concerns remain elevated, and there is no clear de-escalation of tensions ahead of the Vienna meeting. Under these conditions, gold would build on its current momentum, break through near-term resistance levels, and accelerate toward the key $5,340 mark. We could see a strong, steady rally throughout the US trading session, with prices closing near session highs. This would confirm that bulls remain fully in control, setting the stage for a potential breakout to new highs early next week. Now, the worst-case scenario for Friday. In this case, markets react to signs of de-escalation in geopolitical risks, leading to a wave of short-term profit-taking in gold. The US dollar stages a minor rebound, and yields edge slightly higher. As a result, gold pulls back from recent levels. However, and this is critical, the downside will be limited. We would likely see support hold near key technical levels, and the drop would attract dip buyers quickly. This would be a healthy, controlled correction, not a collapse. Even in the worst case, the medium-term uptrend remains fully intact. To wrap this up, here's the big takeaway from today's analysis. Gold is in a strong medium-term uptrend, supported by Fed policy, dollar weakness, and global uncertainty. Short-term pullbacks are normal, but they are not a reason to turn bearish. Friday's trading will likely be defined by position squaring ahead of next week's Vienna talks, but the overall bias remains to the upside. Whether we see a strong rally in the best case or a mild pullback in the worst case, gold's underlying story has not changed. For long-term investors, patience will be rewarded. For short-term traders, manage your risk around key support and resistance levels. That's our full breakdown of the gold market for you today, right here on Market Meridian. Be sure to stay with us throughout the trading day for real-time updates on commodities, currencies, and global markets. I'll see you after the break.